Roth conversions were the best way to save on retirement taxes. But after the recent tax law changes and new data, these same strategies can actually make you pay too much in taxes. So in this video, I'm going to show you exactly why smart retirees are abandoning Roth conversions in 2026 and what they're doing instead to protect their savings from the IRS. To start, I need to show you how the Roth strategy that was saving retirees thousands can now lead to actually paying more in taxes, using Mike and Diane as an example. This chart here shows their required minimum distributions over time. Because they've saved over $2 million in pre-tax accounts, the required minimum distributions the government would force them to take out each year would be over $200,000 by their early 80s. And because that income stacks on top of the income they already have from Social Security and a pension, it can push them into a higher bracket and lead to thousands in extra taxes. So Mike and Diane were using Roth conversions to move money out of those pre-tax accounts now to avoid paying too much in taxes later on. But in 2026, they had to completely change their approach. And the reason had nothing to do with their income or their RMDs. Back in 2017, the Tax Cuts and Jobs Act changed both the tax rates and the size of the tax brackets. And until late in 2025, this was set to expire, and tax laws were going to revert to the old brackets from before the change. So now that the One Big Beautiful Bill Act made the current tax brackets permanent, and they're not going to revert back to the old ones, what does this mean for Mike and Diane and for your Roth conversions in 2026? On the left, you can see the current brackets, and on the right, you can see the old ones. The same income that puts Mike and Diane in the 24% bracket now would put them in the 28 or 33% bracket. So to get ahead of the upcoming change, their strategy was to do Roth conversions up to the 24% bracket. But now that the tax brackets aren't going to change, they need to change their strategy. Right here shows a projection of Mike and Diane's income over time, but instead with those new brackets. The top line shows the 24% bracket, and the second line shows the 22%. Instead of being pushed into the 28 or 33% bracket, now they're in the 22% bracket for most of retirement, with a few years in the 24%. So the same income that was going to push them into a higher bracket doesn't anymore. And when we go in and add Roth conversions up to the 24% bracket, here's the impact. The same strategy that was going to save them tens of thousands in taxes now leads to them actually overpaying in taxes by more than $50,000. And if you want to find out whether Roth conversions are still a smart move for you, there's a link below for free access to the same software I'm using here. You can follow along with your own figures and see exactly how the tax law change impacts your strategy and your legacy. But the change in tax brackets isn't the only new tax law change that's making retirees abandon Roth conversions. The new laws also added an additional bonus senior deduction. For anyone 65 or older, you can get an additional deduction of $6,000 for an individual or $12,000 for a couple. So for many couples, this can lead to a few $1,000s in tax savings. But when you do Roth conversions, they can force you to lose that deduction. Conversions count as taxable income stacking on top of the income you already have. So if your income is $100,000 and you convert another $100,000 on top, now your income jumps to $200,000. And what many retirees miss is that this new deduction changes based on your income. For couples with income up to $150,000, they receive the full $12,000 deduction. But once you cross $150,000 in income, the deduction starts to phase out. And once you're past $250,000 in income, you lose the deduction altogether. So if you're 65 or older and do Roth conversions, that extra income can lead you giving up thousands of dollars in extra tax deductions and giving more of your money to the IRS. But these tax law changes aren't the only reason to stop doing Roth conversions. Vanguard recently released a new study that's making retirees completely rethink whether Roth conversions can actually save them taxes. When most retirees think about conversions, they ask themselves one question: what is my tax rate now, and what will it be later on? But in Vanguard's study, they found that doing Roth conversions just based on your tax bracket misses the most important factor. When you do a conversion, it generates a tax bill, and the money to pay these taxes can only come from two places. You can either use money from inside your IRA itself, or you can use outside money from another account. Let's say you convert $100,000 and you use $20,000 from inside your IRA to pay the tax bill. That means you'd only get to move $80,000 to your Roth. So the $20,000 you use to pay the taxes is $20,000 that doesn't get to grow tax-free. But instead of this, let's say you use money from an outside account. Doing this lets you move the entire $100,000 into a Roth and get the most money possible growing tax-free. And that's what Vanguard found in their new study. Here's exactly what they said. A Roth conversion can be very attractive if the investor can liquidate assets held in a taxable account to pay the conversion income tax. In effect, the conversion allows more dollars to be placed in a tax-advantaged account. So in 2026, smart retirees aren't just asking, what bracket am I in? They're asking, do I have the right dollars to pay the conversion tax efficiently? But even if smart retirees aren't doing Roth conversions, this doesn't mean they're just giving up on trying to protect their savings from unnecessary taxes. They're just using 3 different strategies. So let's go back to Mike and Diane's plan so I can show you how this first strategy can save them over $50,000 in taxes. This chart shows their asset allocation across their accounts. Right now, each account is invested the same way, 50% in stocks and 50% in fixed income. And this splits up the growth pretty evenly. But the problem with this is the tax treatment across these accounts isn't the same. So instead of having their stocks split evenly across their accounts, we move those to the Roth and remove the fixed income to their IRAs. This keeps their overall risk the same, but helps keep more of that growth tax-free. And just making this one change can save Mike and Diane over $50,000 in taxes. So the first strategy smart retirees are using in 2026 is asset location. This keeps more of that growth for yourself instead of giving it away to taxes. But the second strategy is about your specific investments. And getting this right can help you keep hundreds of thousands of dollars more after taxes, even with the exact same returns. Think about your retirement investments like a bucket full of water, but with a tiny hole in the bottom. You can keep pouring more water in, but some of that water will always keep leaking out. Many retirees have that same hole in their portfolio. Let's say you have a taxable brokerage account and you buy an investment for $100. If the price goes up to $110 and you don't sell, you usually won't owe any taxes. But for many retirees, the price of their investments going up isn't the only way they increase in value. Many investments also pay dividends or interest along the way. And if that same $10 of growth comes as a dividend or interest instead, you'd owe taxes on that $10 this year. And because you have to pay the taxes, you can't reinvest that entire $10. So what's the impact of losing that small portion to taxes? This shows the growth of a $500,000 investment that loses 1% per year to taxes versus 0%. Losing just 1% per year to taxes would mean an ending wealth difference of $362,000 over 20 years. So strategy number 2 is to hold these investments that pay dividends and interest every year in your retirement accounts instead of your taxable brokerage account. When you're forced to pay taxes on the dividends and interest each year, it can reduce your returns over time and cost you hundreds of thousands of dollars. And the third strategy is about avoiding triggering what's called the tax torpedo. Let's say you need an extra $1,000 from your IRA. That means $1,000 is added to your taxable income. But the IRS may treat it like more than $1,000 because it can pull more of your Social Security benefits into the taxable column. In some ranges, that $1,000 withdrawal can make up to $850 of Social Security benefits become taxable too. So your taxable income really rises by $1,850, not just that $1,000. And because of this, someone who thinks they're in the 22% bracket can end up paying an effective tax rate of over 40% on that extra $1,000. So strategy number 3 is to avoid triggering the tax torpedo. This can get complicated, so make sure to talk to your financial planner or CPA for specifics on your situation. But the key is to have different kinds of money available. This allows you to make sure your income doesn't get too high and keeps you under key thresholds. But even if you have other money available to avoid the tax torpedo, you're at risk of triggering it anyway if you don't have a plan for how to handle your RMDs. And these can force you to take out massive amounts and end up overpaying in taxes by thousands. So for the exact plan to avoid RMDs pushing you into higher brackets and higher taxes, check out this next video.